Coming up in today's show, stocks finish higher across the board after more dovish comments from a Fed president, bullish positioning nears records, what could be a big risk for the market next year, US military responds to threats in the Red Sea, pushing up the price of oil once again. Hey, what's up guys? Welcome back to the Click Capital Daily Market Show. I hope you're doing well. I'm going to get you all up to speed on the latest news, data and charts across financial markets. And whether you're an active trader or investor, you're going to find a lot of value by staying up to date on all the latest news and trends with this show. It was quite a bullish Tuesday on Wall Street. All the major indices finished higher, led by small caps. We've got the Russell 2000 up almost 2% and a little bit of softness in mega cap tech with NVDA, the only major stock to finish lower today. And we can see here on the charts, we keep grinding higher in the S&P 500. Now within about 50 points of all-time highs at 48.18. However, we are getting quite technically overbought here. And this could be a zone where the market at least stalls out and consolidates, if not does a bit of a pullback. And same with the Russell 2000, just taking you out to a weekly chart. That's in a resistance zone now and is currently in its 6th consecutive green weekly candle. But stick with me because I'll come back to the charts in a bit after going through all the news. So what's really got markets moving this last month is quite the pivot from the Fed, from hawkish to dovish. And we saw that again today with San Francisco Fed President reinforcing what we heard from Jay Powell a week ago, saying rate cuts could be needed next year to prevent over-tightening. She went on to say central bank must make sure we don't give people price stability but take away jobs. Also saying that if inflation continues its steady decline of recent months, the Fed's benchmark interest rate will still be quite restrictive even if we cut rates 3 times next year. So the Fed and the market as a whole just stopping short of declaring victory on inflation and now starting to see risks to the downside of having a restrictive rate for too long. And so it's no surprise that we're seeing stocks rally up really hard. And like research out of BOA today says the long-term bull market in stocks is alive and well, pointing to various market indices beginning to stage upside breakouts from big bases on the Dow and other key indices, saying that suggests the secular bull market is continuing. We even got Goldman Sachs boosting their 2024 stock market forecast by 9%. They were previously targeting 4,700 on the S&P next year. Now they're looking for that to get to 5,100. And they cited resilient growth and falling rates should benefit stocks with weaker balance sheets. And we've already seen a bit of that price action in the market with regional banks with those vulnerable balance sheets ripping up really hard these last couple of weeks. So that takes a bit of pressure off their unrealized bond losses. We even got one of Wall Street's biggest bears throwing in the towel again, saying the Fed has given investors a good reason to be bullish next year. And that's Mike Wilson from Morgan Stanley, saying the Fed's guiding the US economy towards a sweet spot. Going on to say this is a bullish outcome for stocks because it means the odds of a soft landing outcome have gone up if the Fed is going to start focusing more on sustaining growth rather than worrying so much about getting inflation all the way down to its 2% target. However, like a lot of Wall Street strategists and analysts, Mike Wilson doesn't have the best track record over the last year. When it comes to his calls on the market, I know this is a bit of a blurry chart, but just looking back from March when he said sell any stock market bounce, into April when he said the S&P could fall up to 25%, into May when he said the rally isn't the start of a new bull market, traders are being fooled, into June when he said the S&P will finish at 3,900, and then right at the top in the previous peak for the year, he capitulated and said I was wrong. Then when the market fell in October, he said the S&P could plunge another 25%, and then right at the bottom just in late October, he said there will be no year-end rally. So maybe he'll get lucky on this 9th call for the year, or maybe he won't again. Things are so bullish out there, we're even getting headlines like throw your cash in the trash. Investors will swap dollars for stocks if interest rates fall next year. With strategist Ben Emmons saying a weaker greenback promises to boost commodities and emerging markets, saying investors put a lot of money into money market funds this year, and as rates come down, those investors are going to start pulling that cash out and putting it back into growth assets. But another sign of extreme bullish positioning, fund managers most upbeat on stock market since January last year. That's Bank of America's latest survey finds sentiment among global fund managers the strongest since January 2022. In addition to their cash levels dropping to 4.5%, that's a 2-year low. In addition to that, we're seeing individual investors taking up the get me back in trade. The S&P 500 fund sees its biggest single day inflow ever. That's the SPY. Pulled in $20.8 billion on Friday. So it's no surprise we've got the Fear and Greed Index at levels we haven't seen for a while now in the extreme greed zone at 79. Along with the AAPL Investor Sentiment Survey, bullish readings back at yearly highs, along with bearish readings at yearly lows. But just hold up for a second, says Rick Reeder, the bond guru from BlackRock. Don't put all your faith in the Fed with the March 2024 rate cut. Says it's still unlikely. Going on to say, I don't think Chair Powell meant to be that aggressive about starting to cut this quickly, saying the market might have got a bit ahead of itself in interpreting how dovish Powell was, which is not wrong when you look at Fed Fund futures. Now pricing in a 75% chance the Fed's going to cut in March. Going to have to see some lower CPI prints. Oil's going to have to stay low, or something surprising is going to have to come along for the Fed to start cutting rates in just a couple of months from now. Not only that, we've still got the Fed draining liquidity from the market, which should act as a bit of a headwind and is the opposite of what has been the last 15 years a massive tailwind of liquidity pumping into the market. And so the higher risk assets go, the more room that gives the Fed just to sell into that and reduce their balance sheet. On top of that, we've got record treasury issuance coming in next year. And Powell himself has pledged that quantitative tightening will continue unless the economy collapses. So of course the Fed put will always be there. However, the Fed is keeping their QT to about 100 billion a month, and they've already reduced their balance sheet by nearly 1.3 trillion from its 9 trillion peak in 2022. And on top of that, the Fed is expected to try and sell 4.6 trillion of debt next year. That's well up from 3.3 trillion we saw this year. And that huge supply of treasuries should be somewhat supportive of higher, longer dated yields. But for now, the markets, both stocks and bonds, really focused on the Fed's dovish pivot. Got the 10-year Treasury yield returning to the lowest level since July. And that was after the Bank of Japan kept its negative interest rate policy and gave little indication of a potential shift in its ultra-loose stance anytime soon. And there's a look at the daily chart of the 10-year yield. It's been in this persistent downtrend since the start of November. Now currently just sitting at 3.93%, which is over 120 basis points lower than where the current Fed funds rate is. However, now many are considering US bonds are now in a bull market, with the most popular TLT soaring 21% from levels in late October, as the market's convinced the Fed's going to go through with a series of rate cuts beginning in March. And we can see that in the daily chart of TLT. After getting really smashed down this year into the middle of October, it stalled out on a bunch of volume, and we've got quite that pop-up from those low 80s, now pushing up towards 100. However, what could potentially upset this theme going on in markets is an uptick in inflation. And to get an uptick in inflation, we need an uptick in oil. And what could help get an uptick in oil is if we get more tensions and conflicts coming out of the Middle East, like we've been seeing recently in the Red Sea, an important shipping route. Over 10% of global trade goes through. And that's from another Iran-backed militant group attacking commercial ships going through the Red Sea. But like I said last week, the US military and its allies is likely to respond to that and neutralize that threat. And we've just seen that with the Pentagon announcing a new international mission to counter attacks on commercial vessels in the Red Sea. And they've already started shooting down some of those drones that have been attacking the ships. So that shouldn't be a problem. And OPEC, who want the price of oil higher, can't seem to achieve it by cutting production and promises of more cuts. That's because other countries will fill the gap. That's non-OPEC nations like US, Brazil, Guyana, which have surprised oil markets this year with record supplies. And that's at a time when we've got a lot of softness in the global economy. However, nonetheless, oil futures did perk up a little today. Seem to be getting a bounce off those mid-67s. Now getting back towards the 50-day VWAP, currently at 75.50. Now there's not too much volume coming on this bounce. Looks to be a little bit of a soft one. And like I said, any conflicts over there, the US and its allies, it's not going to let these little militant groups disrupt global supply chains. They'll do whatever's necessary to flatten them out. It's more a story if the US consumer, China and the Eurozone sees a pickup in demand, because we do have a lot of supply out there. And so it could be a case of oil just oscillating between $70 and $80 a barrel for some time. One of the biggest stories in the stock market this year is the new blockbuster GLP-1 weight loss drugs, helping to suppress appetites. We've now got Goldman Sachs saying Eli Lilly, which is already the biggest pharmaceutical healthcare stock in the world, could soar 140% by 2028 as more people use these weight loss drugs. And they're estimating if all GLP-1 trials succeed, 68 million Americans could be taking the drugs by 2028, with total revenue having the potential to reach a huge $400 billion in a scenario where all the 23 upcoming studies are successful. And so that is a huge market for Eli Lilly, because it could be 20% of the country's population on these pills. And it's why the stock's up almost 60% year to date. Whilst on the other side of the coin, we've got some of those cheap sugary snack makers like Kraft Heinz, still down over 10% year to date, even after this big rally over the last month and a half. And probably the world's largest snack maker, coming out of Switzerland, Nestle, hasn't enjoyed the rally of late. It's still down over 11% year to date. And just looking at Coca-Cola and Pepsi, they're still lower than where they started the year as well. So the market's thinking and pricing in this is a bit of a secular trend. If the average consumer is eating 20 to 30% less calories per day, then those less calories are likely to be taken away from those convenient snacks in between meals. However, that hasn't really been showing up in their quarterly profits just yet. This is more of a long-term story. And that's why we've seen those drug-making stocks like Eli Lilly and Novo Nordisk have huge rallies this year. Just looking at economic data we got out today. This is the BOJ holding their interest rates in negative levels. Year-over-year inflation rate, the Eurozone, 2.4% coming in as expected, and Canada's inflation rate coming in a bit higher than expected. 0.1% growth month over month, with their headline coming in at 3.1 year over year, and core higher than expectations as well, 2.8% year over year. Big pop up in housing starts in the States, month over month, 14.8%. And just looking at corporate insiders, still doing quite a bit more selling than buying of late. Just looking at my custom indicators, institutional buying percentage, still flirting with those bearish levels. The S&P 500 oscillator, still walking the line in those overbought levels, currently at 63.6. Looking at breadth today, we got 838 stocks and ETFs hitting 52-week highs. Notable among them are AMD, Amazon, Meta, Coinbase, Netflix, JP Morgan, Salesforce, Carvana, Shopify, MasterCard. Other side of the coin, we've got 51 stocks and ETFs breaking down to 52-week lows, mostly just short and bearish ETFs, a bunch of Chinese stocks, and just some other individual small cap stocks. Breadth as measured by the amount of stocks above the 200-day average, still really strong here at 75%, and VIX still really suppressed at 12.5. However, we are getting a bit of a premium developed in implied volatilities, and put-call ratio is still really low, and that's because we've still got a really lopsided option market. Pretty busy for a Tuesday, 40.8 million contracts traded, and still people piling into calls, 63% today. High yield bonds still trading really strong, also helping risk assets. There's the dollar in a downtrend, now under 102, with Bitcoin still stalling out just above this 40,000 level, and commodities as a whole trying to find some support down here, with gold still holding above 2,000 level. International stock indices had a good Tuesday session, all finishing higher, still looking for a bottom there in China, and the Aussie 200 ripping up once again. There's that big rip up in high beta stocks versus low volatility, and small caps really outperforming large caps. Saw that again today with the Russell 2000, and the market is in growth mode. There's discretionary stocks outperforming staples. However, global economic growth, as measured by copper versus gold, still stumbling sideways, has been in a downtrend this year, and high yielding bonds versus treasuries breaking out again today. Inflation expectations still on a short-term downtrend. Over to stock sectors, I added a new sector in here today. That's the dry bulk shipping ETF, under ticker BDRY. Very volatile, but helps to give a look at the shipping stocks, which can be a key indicator of global economic growth. And that's ripped up quite a bit over the last month and a half, especially the last week or so with what's going on in the Red Sea. We did have a bit of a pullback today. The only other sector that finished down today was the cannabis one, MSOS. Winning sector today was ARC Innovation, up 4.1%. Coming in second was Junior Gold Miners and Clean Energy, looking to hold on to this bottom formation it's put in. There's the BlackRock barometer holding up there, and what a tear JP Morgan has been on. This thing's gone absolutely parabolic and continues to rip up to 52-week highs today. Same with the largest stock in the market, Apple, not too far away from all-time highs. It's actually NVDA, which we saw have its second highest close ever yesterday, above $500 a share. Just pulled back a little bit today. Still getting some nice pop-ups in meme stocks like Robinhood, up 10% today. And actives today was Affirm, up over 15% on the back of news that they're partnering with Walmart to offer their buy now, pay later services at self-checkout kiosks, helping consumers to get further into debt, already at all-time records. Got a nice pop-up in Pfizer today. I think we may have put in a bottom down here when we gapped down into the high 25s. Same with Alibaba, climbing again today above 75. Intel holding near highs. Same with General Motors, and another nice pop-up in Walgreens today, closing just above $26 a share, and continued strong price action in all the regional banks, including the big guys as well. Loving these lower bond yields. Alright guys, there we are on the S&P 500. This parabolic trend is showing no signs of stopping. We just continue grinding higher and higher, but this could be a zone where we stall out right around all-time highs just above 4,800. So we may come up, peek our head above that, and we'll just have to wait and see what sort of price action we get there. And if we get one of those big surprise red candles like we saw in the gold market when that popped up to all-time highs, there was a bunch of sellers just waiting to come in there. However, for now, the market's got everything going for it. Lower yields, really strong breadth, huge amount of bullish consensus and optimism. It's going to take a real surprise to knock this thing over. Otherwise, we should be due a healthy pullback or consolidation at some point in the near future. However, we're now moving into the quiet part of the trading year where volume and volatility and news flow starts dying down, going into Christmas, and doesn't really ramp back up until we start getting into the second weeks of January. That's all I got for you today. Thanks very much for coming back to Click Capital, and I hope to see you again tomorrow night. Cheers.